Hello, guys. It's really happy to be with you again. Here is Jan from Prague, and we have Dan, aka Quinolog, in South Bohemia, as we just rebranded him with Charles, our guest. He is our Oracle of Bohemia, like Oracle from Omaha. And we have our guest, Charles Lichfield, joining us from Washington. Hello, Charles.
Hello, thank you for having me.
So just super quickly, laudatio about our guest, who is really cool on US and not only US economy, and this will be topic today. So Charles Lichfield is deputy director and a senior fellow at Atlantic Council, Washington. Previously, he worked with Ian Bremmer at Eurasia Group. He worked a lot on Brexit. He is Irish, British, national, so still a member of European Union. He was born in Washington, and his childhood years were in Paris, correct?
I'm amazed you got it all right. I only briefed you a few seconds ago. Well done.
And he wrote extensively commentaries and analyses, Bloomberg News, BBC, Financial Times, Le Figaro, and German Bild. He's economist from London and also studied German and Russian at University of Cambridge. Which college, if I may ask?
Jesus College.
Okay, so I was very, very near you at Downing. And nevertheless,
my director of studies was a very famous Czech linguist called Jana Howlett.
Splendid. So there is a Czech connection. So let me shoot for first question, and then let's see where the conversation will bring us. So there was a big sell-off in U.S. stocks in August. Shall we be afraid of anything worse in coming future, or it was just short-term volatility?
Well, it was very volatile. I think that's the first point. We broke records of volatility. The VIX went extremely high. I think it was several factors coming together almost by coincidence at the same time, or things that needed to happen being triggered by one in Japan. So I don't think we should sugarcoat the fact that the volatility was extremely high. I'd be interested in your opinion as well. I'm not a markets oracle, unlike one of our participants. But no, it was significant. And I think it just removed a sort of veneer of optimism from, or gave us a better insight into the fact that the markets had been motored and pulled to the top by the Mag 7, by tech stocks, which were perhaps a little bit overvalued. That being said, the rally that has gone on since, I'd say, the summer of 2023, only a little bit of that delta has been lost. So I don't think there's any cause for alarm, but it has caused the markets to rebalance their attention to other stocks, and some of those are good news. So the fairly common consensus view that interest rates will come down is very good for mid caps, which have found it very difficult to get funding because they're a bit smaller in a high interest rate environment. So a little bit of insight into my own investing strategy. My a mutual fund that focuses on mid caps has been very sluggish for the whole year, but is now doing quite well. And investments I've made into boring mutual funds that track the Mag 7, that's lost a little bit. But the gains since summer 2023, most of those haven't been wiped out. So I think that's how most people feel, much more relaxed than they were on the day when markets fell quite significantly and the VIX was quite high. But hopefully we learn from this exactly what's going on. Mag 7, perhaps a little bit too much attention, and everything else I think we can be reasonably optimistic about. One last remark is on jobs data, which has been a little disappointing, and that has caused the market to fall on other days since the big day of volatility about 3 weeks ago. I mean, this jobs data is disappointing compared to expectations, but it's not bad. It's the US market creating 140,000 jobs instead of 170,000 jobs. So in comparison to financial crises, this is, it's just not comparable. There are sort of jitters and there's nervousness, people feeling perhaps we've been a little too optimistic and we need to pull back. But I don't think we're in crisis mode yet. And the news this morning, for those of you who are following it, was reasonably good, that the US is in line with, or coming back in line with, the inflation target, and therefore it seems pretty likely that interest rates will be brought down, and that will be good for markets, both large cap and mid cap.
Yeah, you're absolutely right. By the way, the stock market is again very close to all-time high, and not only in the United States, it's in Germany as well. For example, it's very surprising. On the other hand, there are a lot of predictions that since 2023, probably, that the world economy will slip into a recession. but there are no signs at all. So, what is? Do you have any explanation for this very weird development?
I mean, what is a recession? During the 2008-2009 economic crisis, the actual global GDP was still growing. It was just that in the main markets that we're used to following and that have been the most successful economies in recent decades, the economy was shrinking. And that was enough for everyone to call it a recession, but it wasn't, in fact, a global recession. Then there are definitions between the US and the EU, slight differences in how they define a recession. Usually it's 2 consecutive quarters of negative growth. And we have actually gotten close a few times in the US. And in really important economies in the EU, it's confirmed that we were actually in recession over the past 2 or 3 years. There were 2 consecutive quarters of negative growth in Germany, an important economy. And the data out of the UK shows that they're still flatlining. So I don't think the data is invariably excellent. It's sort of middling and depends on where you look. There is a disconnection and a discorrelation between how markets feel because they've been carried by some valuations in the tech sector and how the real economy, in quote unquote, in inverted commas, is doing, where it is actually a little more sluggish than we'd like it to be. So I don't think I wouldn't blame any economists for making predictions on recessions when, in fact, we've just been on a very, very fine line or on a knife edge about whether we're actually growing or shrinking in developed economies. And personally, I'd like to see an additional 1 point or 1.5 point of growth in all of the economies I've mentioned. So I think that's why we've been on a knife edge of whether we're in a recession or not. And ideally, we'd be growing much faster.
We are recording this interview with Charles just a few hours after ABC debate between Vice President Harris and former President Trump, and it was a lot about economy. It was a lot about America first, different wording, but from the both sides. The globalization is not sexy anymore now in this presidential election. It's actually both parties, again, different wording, but they call about protectionism. Kamala Harris, now Vice President of the United States, is part of administration that created under Katherine Tai U.S. Trade Representative Inflation Reduction Act, which at the end is not more trade but more investments back home. So, do you think now, when you look into the dynamics on both parties before elections, do you think that protectionism is new zeitgeist? This is what will happen no matter who will be the president of the United States?
Well, between the 2 candidates, neither is offering a path to more opening of the US market. So its shorthand would be, I'd agree with you, it's different degrees of protectionism. That being said, let's look at what kind of protectionism and also compare the US behavior now to in the past. The US economy has never been that open. It has a philosophy of openness which it likes to see around the world. It likes other countries to be open to US investments. And the ease of doing business in the US means that a lot of global companies want to have operations in the US and want to be selling into the US. So there's a sort of feeling that the US is an open economy, when in fact, just if you do a simple trade as a ratio to GDP, it's extremely low. Part of that is structural. It's because of the size of the US market and its own access to natural resources. But some of it is also philosophical and political. People, your very knowledgeable audience will know that every state gets 2 senators, and so senators, and so a lot of states that aren't particularly populous do have a stake in U.S. trade policy, can vote in favor or against trade deals, and therefore this sort of general way the U.S. has had of doing things compared to, let's say, the EU, has been that bit more protectionist for a long time. That being said, there's now a feeling that things have gone too far, even if trade to GDP isn't that high. There's a feeling that the US is too open, that too many jobs have been lost to Southeast Asia, to China, and therefore since 2016 there's been I'd say a different choice of wording, a different rhetorical approach to trade. In practice, it has also been very different because you've had tariffs being imposed in a punitive way, very high tariffs that are targeted and that are unilateral. The US always had a difficult relationship with the World Trade Organization, but at this point, there just isn't much of a relationship. We don't need to go into the detail of appellate courts and the US blocking the appointment of judges. But the point is the US doesn't even claim that it expects the WTO to sort out the problems that the US feels are there. It will do it unilaterally. And whether you have a President Harris or another Trump presidency, that approach will remain the same. But then there are very different degrees of punitive tariffs. So the outgoing Biden administration has said that it will impose a 100% tariff on Chinese electric vehicles. And Trump, at least at a meeting, said, well, I'd do 200%. Not necessarily in the manifesto yet, but that's the stage we're at. The Trump campaign is also claiming that there'll be a blanket 10% on any good being imported. So there has been a shift. I don't want to deny it, but I think it's important to acknowledge that the U.S. economy, it's very easy to do business in the U.S. economy, and most businesses want to have access to the U.S. But in terms of trade to GDP, it's not actually that low. For Germany and Czechia, it's much, much higher.
Yeah, it's very interesting because when we talk about protectionism, we have in mind especially like a trade and stuff. But when we see what's going on in capital markets, so the U.S. is a very good goal for European companies that are striving to put its IPO on the U.S. markets. And in general, the U.S. is very open in a financial account. Does it have any consequences for the world economy or for the U.S. economy, or does it matter at all?
No, that matters very much. And some of the things you mentioned are phenomena that were brought up yesterday or the day before in the Draghi report. This sense that startups with a future tend not to launch their funding rounds in the EU, or at least they do the first ones, but then at some point move to the US because the pools of funding are deeper. I think there's a network effect there which does have global consequences. I think later in this conversation we'll come back to the dominance of the dollar, but there's a network effect between the deep pockets of funding, deep pools of funding that are dollar denominated, the ecosystem, the know-how, the legal system. So all of those things mean that at some point, even with a fairly big consumer market in the EU that is meant to be unified as the single market, and the single market has many achievements, people are naturally drawn to the US. And that's before we even talk about the IRA, which I didn't mention in my previous answer, excuse me. But yes, to some extent, the IRA compounds what the US does very well, which is it isn't necessarily an open market to trade, although the US officials would argue that it's very easy to do business with the US and the rules are clear. So please come. And generally, people feel quite welcome doing business in the US. It's not that open relative to GDP. What the IRA does is, and it compounds some strength that the US has had at attracting investments and attracting companies that have had a good idea elsewhere, but feel that to develop it and to scale, they need to do it in the US. The IRA focuses on a few sectors that are sort of sectors of the future. So green mobility and green energy generation. There are a few things that are a bit less green in the IRA, but don't need to go into them. So it does that in quite a sort of interventionist way. It does things that the Europeans are quite uncomfortable with, like not only by putting in a stipulation that a good, in order to receive the tax credit, has to be assembled in North America. So those local content requirements, going further than just a subsidy, so it's not only a subsidy, but it also has a local content piece. I think that's what's sort of demonstrably against at least the philosophy and the letter of the WTO, and that's what the Europeans have had a problem with.
You mentioned the dollarization. The dollarization is a topic for quite some time. Chinese were playing with the term already, 10 years ago, renminbi going abroad, Asian investment banks and basically Asian structures as a sort of competitor to Bretton Woods system, IMF and World Bank. Then the Russian war on Ukraine started, and Russians were playing with let's do all the tenders outside the dollar. Finally, there was an era when the Gulf countries, namely MBS, Prince Mohammed in Saudi Arabia, he tried, okay, let's do a little bit less in dollar, let's do renminbi. Nothing like that materialized. Dollar is strong, maybe strongest ever. There are people in Russia with a lot of Indian currency, and there are people in Saudi Arabia with a lot of Chinese currency, but what to do with it? But do you see any risk going forward that there will become this de-dollarization, or is it just a myth?
I don't think it's a myth. I think I think it's absolutely right to think about this cautiously and think about any sorts of precedents we might set with our sanctions policy that would accelerate something that I think is happening slowly. And you're right, not noticeably in the data yet. Two of my colleagues at the Geoeconomic Center, Maya Nicoladze and Rogan Kusari, put together a really cool dollar dominance monitor. And I won't hide that finding the title for this monitor, this tracker, was quite difficult because maybe at some point it might have been an idea of ours to call it a de-dollarization monitor, and then the data showed that the dollar was so dominant that we called it the dollar dominance monitor. So obviously we start from a point where, in terms of invoicing, in terms of reserves, the dollar is above 50% worldwide, which is huge for a currency. That being said, those indicators are lagging. They look back at the past, at what has happened until now. They're not leading. They don't show what is happening, what countries that you've just mentioned are doing in order to build systems that don't rely on the dollar as much or not at all, and just how quickly the switch could happen. And I do try to tell people that the switch can happen faster than you think. If the invoicing moves away from the dollar, gradually, of course, there's less of a reason for a country with a huge trade surplus like China to be accumulating dollars. And therefore, what their central banks do, it's their job to keep the dollars and then exchange them for the local currency so people can pay salaries and public services can operate, etc. That mechanism is how you build up big reserves, and it's what sort of entrenches dollar dominance and the euro to some extent in countries that have wanted to also invoice in the euro and build up reserves in the euro. So the switch can actually take place quite quickly. If you're invoicing less in dollars, you're accumulating fewer dollars, and therefore it has an implication for your reserve composition. So this is the sort of thing we try to draw people's attention to. It's why we at the Geoeconomic Center are quite careful about precedent. To mention the very interesting debate about what should happen to Russia's immobilized reserves and whether they should be directly given to Ukraine or whether we need to be a little more cautious and just use the interest. I've been quite active in that debate. So I think the data doesn't necessarily reflect a cause for concern, but you need to look at the underlying behaviors and remember that actually the data could change quite quickly if these behaviors are become a pattern.
Yeah, but how real or how probable is that the dollar can be I don't want to say replaced, but added maybe with other currency,
becoming less special. What really entrenches the special nature of the dollar, I think, is the precedent confidence that having a dollar means that you will always be in possession of that value and ultimate trust around the world, the network effects. So the dollar has that special status, and let's be fair to the euro, I think it's second, a very, very distant second, but the second, and with the same underpinning of confidence and a legal system that people trust. If you start undermining that, they're not special anymore. And so I don't really have interesting or convincing predictions for you on how quickly that could happen. But I think it's just important to remember that the pattern of behavior changing can actually make the data change very quickly.
Me again? Okay. Okay. I wanted to move to another point. You have already talked about very special situation, say on the U.S. job market. It's not so nice. But Jerome Powell,
there are jobs being added. It's just slightly below the predictions.
Yeah, of course. But Jerome Powell told in Jackson Hole, and I hope that I say it just very close to what he said, that inflation is not a threat or the primary threat anymore, and he is more afraid of the development of the job market. So, do you agree with him that inflation is behind us, and the job market is the number one of interest?
So I think we're in the sort of end game of whether we have a soft or a hard landing from the period of high inflation. The main central banks of the world rightly had to bring up interest rates. Some responded a little faster, some a little slower, but they all followed that same trend. And now they're in the phase where they're bringing them down. And the test is whether they can do that and we can get back to a normal rate of inflation or the targeted rate of inflation without having undermined growth and without going through a global prolonged recession. So far, so good. But I think Chairman Powell is right to be cautious about getting these final stages right, because you can get the signal wrong and be too quick or too slow, and you have all sorts of conflicting data distracting you when doing this. So shifting attention to the other part of the Fed's mandate, always important to remember they have a dual mandate between full employment and predictable anchored inflation. Shifting the focus into the other mandate as it seems clear that they've managed to bring inflation down, I think is quite a clever thing to do. But maybe the cost of doing these clever tactics is that you have to sort of overemphasize your concerns about the job market when, I mean, the job market is still growing. The US economy is adding jobs, not subtracting jobs. A few other remarks that may be interesting to your listeners, things that I've picked up on as an observer in the US. And I moved here 2.5 years ago, just at the beginning of the full-scale invasion of Ukraine. No causal link. The other thing that I've noticed is just on salaries, just how much bigger they are to Western and Central Europe. Some of you will remember the Bernie Sanders rather successful campaign in the primary in 2016, where Hillary Clinton won, but Sanders gave her a good degree of competition. One of the big promises of the Sanders campaign was $15 an hour. This should be the minimum salary. And this was seen as, somewhat radical and somewhat difficult for small business owners, with exceptions. Some poorer regions of the US where salaries are lower. I do not know of any business, certainly in Washington, D.C., that pays people anything less than $16 or $17 an hour at this point. So $15 an hour at this point, obviously inflation has played a role, but let's compare it to Europe as well. Salaries are catching up with inflation. Obviously, it's very difficult. I don't want to minimize some of the difficulties that inflation has imposed on people in the US as well. But the salaries are higher, much higher than they were, and sometimes not even comparable to where they were 10 years ago. So that's another dynamic to factor in.
I was already starting to be jumpy here, but you sort of stole my pointy question from my mouth. Nevertheless, I don't think that now, 8 weeks before elections, it's so important. Fed guys, Jerome Powell, big messaging. It's about perception. And all the data in both parties and both campaigns show that inflation and price of goods and services, it's a key issue. It's much more important than Israel or Taiwan or Ukraine or, Inflation Reduction Act. This is something that especially GOP, so Trump campaign, is putting forward. And when Trump stays on a message, it's all about very detailed pricing. In 2020, when I was the big guy, prices were 1, 2, 3, 4, 5. Now it's here, inflation, etc. So what's the perception? And do you think that this topic will still have a traction in coming weeks?
No, I mean, it's one of the most favorable topics for the Trump campaign, and they know it, so they use it. My point is simply that salaries have grown as well. And so there's the very famous misery index where you factor in just how much inflation there's been and how much unemployment. And okay, let's modify the misery index a little bit and add into unemployment also a sense of wages and whether they've caught up. And I don't think it's at maximum level at this point, because employment is good and because wages have grown. There are exceptions, and there are people who are having a very difficult time, absolutely. But if you think of the average individual voter comparing their fate and how they feel about their lives now compared to 2020, I don't think the comparison is going to be that difficult or that challenging for Harris. Trump is right to use inflation because you feel it, you see it, and it's at the point where it's something that's a sort of everyday discussion topic. Another point that I think is important is in Europe, I think people associate the inflation, at least to an extent, with the war in Ukraine. The average US voter wouldn't do that. And so they would blame their local managers, so to speak, the people in charge, for inflation. So that's a weakness for the Harris campaign. It's seen as Joe Biden's inflation. It's because too much money was pumped into the system. They don't necessarily blame the Inflation Reduction Act, That was a clever branding exercise. I know it's a stimulus, and so it actually, in some ways, contributes to inflation. But they would blame the initial response to the pandemic, which, let's remember, the pandemic started under Trump, and he also put out a stimulus with just a blanket check for everyone. But okay, that was in the first phase of the pandemic, and governments really needed to come to terms with something unprecedented. But then the Biden administration went for, arguably 2 additional rounds of huge stimulus. The average voter would consider inflation to be the government or the administration's fault. That's true. They wouldn't cut them some slack because of the war in Ukraine, which maybe a European might be slightly more likely to do. But salaries have followed through. Salaries are higher. And so I don't think it's the misery index isn't at maximum level.
Let's stay at macroeconomic level again. And I would like to know what's your opinion on interest rates. And I try to get you into this question. First, we had a surplus savings in COVID era of US households, but these surplus savings are exhausted. So interest rates for US households are again very important. And when we talk about interest rates, we have to talk especially about real interest rates. And because inflation is going down, so real interest rates are going up because Fed is still holding interest rates at a very high level. So what do you expect will happen in the near future? Does Fed will be forced to lower interest rates because of economic reality?
They're already putting out signals that they are going to in September. And so I think it's consensus and it comes across as the sort of natural thing to do. However, in your question, there was some interesting context that I suppose I should pick up on. Yes, people have less savings than they did coming out of the pandemic. They've spent them. And so consumer credit becomes that bit more important. I do need to factor in the point I keep making, and maybe boring you at this point, that salaries are higher as well. So that also helps consumers. But yes, I think people are expecting a boost. And one of the reasons that comes up quite often is housing. It's quite a bit more difficult to buy property under a high interest rate environment. And there's some sort of holding off, waiting environment. There's a little bit of too much stock and less buying in the market in some parts of the US because people are waiting for interest rates to come down. So we're at the point where economists are saying maybe they've waited a little bit too long. And I think if they didn't bring interest rates down in September, that would be seen as surprising, irresponsible, etc. So we're at that point. That might solve your real interest rate problem. But something I notice as someone who studied economics in a sort of theoretical way, and now I'm much more of a sort of practical observer, is that in theory, you're meant to have a more than one-to-one response to inflation with interest rates, which didn't happen. So central banks, some argue that they responded a bit too late to the inflation. They certainly did bring interest rates up much higher than we were used to over the past 10 years, where we were sometimes flirting with the zero lower bound. But there was no more than one-to-one response to inflation. Inflation was sometimes up at 8-9%, but no one in developed markets brought their interest rates up that high. So my hope is that the responsive but cautious approach will have been justified. And the economist listening will remember Brainerd and Brainerd conservatism, moving things up and then moving them down in very small increments just to test the market at every time. That's what we're seeing. Obviously, they don't give you that much insight to it because they need to keep their sort of magic and mystery about what they're doing. But I think that's where we are. We're in that gradual move to a lower interest rate. Hopefully, we don't go back to zero interest rates again, because that was proof that something else was wrong with the system, that we really needed to stimulate the economy to get any sort of growth. And it caused all sorts of problems for how banks work. So hopefully we land somewhere between 1 and 2.
With Dan, we are both, let's call us Asian hands. We are both connected to Asia. I was living there doing business, and Dan is still trading there. That's why his nickname Queenolog. And we a lot talk about together, and also on our podcast, about household savings, and also surplus savings and excessive savings. In China, household savings are over the roof. We always debate that this is sort of point that the Chinese people don't believe in future. That's why they are basically saving so much. Also, there are not many instruments they can invest to. In the US situation, it's different. Sort of like two ways. There are people who live on on credit, credit cards, stamps, etc. So part of society is not well off. There are no savings, but other part of society is like going up with savings. So do you think the consumption is a problem because part of the society no money, second part of the society basically hoarding money?
I can see why you'd come to that conclusion. I think that's a slightly exaggerated dichotomy. I mean, most US households consume more than average European households, and
Sure.
you just see it in the behavior of a US household. They eat out more, they buy more nice technology, they replace things more often. Something that's visible to European eyes at this point, and good for them. The thing that I think is sort of interesting and structural and noticeable also when you arrive in the US is just how much easier it is to optimize your investment behavior and using your savings, making them work. It's true that most European banks now offer portals for you to use your savings and invest in equivalents to mutual funds, but it's much easier and much more in the culture in the US. So you do have a more positive ecosystem of people's savings behaving in a more active way that's positive for the economy than in Europe. And certainly than in China. And you have to add to that the pension system provides another layer of savings that are being used more efficiently. So that's something that I've noticed that's very different. It's clearly not always being invested in in productive sectors. Sometimes those savings are being lent via the financial system to consumers, and that creates more of a problem because you have more credit card debt and people that are in more of a vulnerable situation than perhaps they would be in Europe. So that's the sort of the dark side of it. But it's just been something that I've noticed that it's much more efficient. When you have savings, the culture is to invest them in a more efficient way.
Okay, so we're approaching probably to the end of our conversation. So I would like to ask my last question. And what I would like to know is, who of the, because we are close to US elections, so who of the two candidates is for you the more preferable, or who would you like to see at the White House, especially from the economic point of view?
So it's very exciting to be able to say something as self-important as the Atlantic Council is a nonpartisan institution, and I couldn't possibly endorse one or the other candidate, which is extremely self-important and pretentious thing to say, but I have to say it. But it's a very interesting campaign, and the Atlantic Council and my center are trying to be helpful by talking to both sides and trying to figure out where things are going and guide them into a mindset where they always think of the transatlantic bond, finding solutions that work with Europeans rather than against or ignore them. And given I'm speaking on this podcast, I think it's very important to talk about your region. It seems we've lost Jan temporarily.
Yes.
So I know that Donald Trump has more of a sort of personal relationship with your region than Kamala Harris might. He's used this in a way that isn't necessarily, I think, in European interests, if you think it through rationally. So yes, Donald Trump knows Czechia, Slovakia, Hungary, and Poland very well, better than your average Republican politician, and this is an asset. This is something that's very good. But the anticipated policy that comes out of that is that he tries to do deals individually with Prime Minister Orban, who's one of the only foreign leaders who was mentioned in last night's debate. Great guy. I like him. I can do a deal with him because he likes the US. So trying to separate the Europeans and work with them bilaterally. First of all, it's against EU law. But also, I'm not sure if it necessarily serves European interests in the medium term. Certainly, having good relations with individual European leaders is a good thing. And I think perhaps some of the most the most scaremongering comment on what a second Trump presidency means for NATO is perhaps exaggerated. I have my own concerns, but it is important to always remember that he has his personal links to your region. But this idea of picking one European off from another is something that he will explore. It's something that will be tempting for some European governments. but I'm not sure it actually leads anywhere good, because let's say Hungary tries to do some sort of illegal trade deal with the US. The Commission will have something to say about that, and the Commission does have leverage over Hungary. Everyone knows that. So I'm not sure that's necessarily an avenue we want to go down. So a word of caution about Trump and his personal ties to your region, although they are obviously an asset which your governments will exploit if he's elected again. And then about Harris, there's a view that she doesn't really have a foreign policy. It's not been her thing, and that Philip Gordon, who will probably end up as her advisor, is well acquainted with Paris and Berlin and Brussels, but not anything further east. I do think that's changing. I think the Czech government, the Polish government have been very good at building networks in both Democratic and Republican foreign policy circles. Also quite good at turning up and, shall we say, making fun of Germany, making fun of decisions made by Angela Merkel in a way that sort of feels quite good to and pleasant to American ears. I don't necessarily condone this type of behavior, because sometimes it's important for Europe to show a united front and a united policy. But the point is that Poland, Czechia have been very good at building these networks with the Harris campaign. And so I'm not too worried that there will be... No, I don't think there's a scenario where Phil Gordon ignores anything that happens east of Berlin, although people always forget that Prague is west of Vienna. So it's a little more complicated. But sorry, no endorsement.
I don't have any more questions, Your Honor. Thanks for being with us. That was Charles Lichfield from Atlantic Council, economist, and we discuss U.S. elections, U.S. economy 2 months prior, 5th of November. Thanks for being with us, Charles.
Thank you very much.
Yeah, thank you very much.
Done.